Hey there, Steve Rubis with another installment of Capital Markets Investor Relations in 2 minutes or less. Today we're going to revisit the Hindenburg EQIX short attack and two important considerations for public executives. And it starts with this idea that who should be speaking on an earnings call, and secondly, why as a public company executive you should never sell your shares until you leave the company. And so let's start with this premise. Investor relations for me is an exercise in managing downside risk. My job is to ensure that an executive is not put in a compromising situation where they're asked inappropriate questions that can trigger Reg FD. I am supposed to act as insurance that that executive and executive team has a long tenure that is fruitful, successful, and enjoyable for the company that I work for. So let's get to the EQIX Hindenburg short attack. It seems to be based on some sort of accounting manipulation. So that puts the chief accounting officer in a tricky situation. And there's two negative data points here around the chief accounting officer. First is the short seller takes a quote from the chief accounting officer on an earnings call out of context to support his short thesis. Secondly, the chief accounting officer sold shares several weeks prior to the short attack, which is another negative data point. So let's get to the two key considerations. The first is who should be speaking on an earnings call. Less is more. You want to protect your executives from downside risk in the future. You don't want an executive making an innocuous statement or explanation on an earnings call today that months or years from now can then be used against him, her, or the company. Keep it to the CEO and CFO. And then secondly, why a public company executive should never sell their shares until they leave the company. Buying and selling stock is the most powerful signal a public company executive can send to the investor community. When you buy, it says one thing, the stock is going up. When you sell, it could mean many things, but depending on the size of the sale, it sends a clear signal that the stock is going down. And you don't want to be the executive that sells at the top or sells several weeks before a scandal hits, as happened in this scenario. So the key learnings for executives are this. A public company executive can do what he or she wishes within the parameters of the law, but be prepared for significant consequences. Do you have the right investor relations team in place to help you manage the downside risk and have a long tenure? Thanks for watching. Always here to help with your capital markets, investor relations, and corporate finance needs.